For more than 2 decades following China's accession to the World Trade Organization, a significant economic relationship developed, heavily reliant on trade flows between China and the United States. This period saw substantial growth, driven in part by Chinese exports fulfilling demand in American markets. However, this established dynamic is now facing severe disruption. The imposition of steep reciprocal tariffs, reaching 145% on Chinese goods by the United States and 125% on American goods by China, has fundamentally altered the operational environment for businesses engaged in this bilateral commerce. Initial rounds of lower tariffs, while challenging, were often navigated by exporters through measures like absorbing profit reductions or negotiating modest price adjustments with clients. An exporter in Ningbo, Geoeconomics, exemplifies this initial phase, managing to secure new orders even after the first 10% tariffs by offering price concessions. Yet the subsequent escalation to significantly higher, near-universal tariff rates has rendered such adaptations insufficient. The same exporter Zhu now describes the situation as lacking even a thread of feasibility, leading to practical consequences such as pausing shipments destined for the U.S. market. This operational standstill reflects a broader uncertainty rippling through the supply chains connecting the world's two largest economies. Businesses are confronted not merely with increased costs, but with fundamental questions about the viability of their participation in the U.S.-China trade corridor. Analysts observe these developments with concern, noting the potential for a significant reordering or even an effective decoupling of economic ties forged over decades should these high tariff levels persist without resolution. The immediate reality for many involved is one of suspended operations and anxious waiting, as they ponder their next steps in a dramatically reshaped commercial landscape. This threshold of manageable adjustment was decisively crossed with subsequent, much larger tariff announcements. An additional 34% universal tariff introduced by the Trump administration, later escalating through further increases to reach a total of 145%, pushed the cost burden far beyond what operational efficiencies or profit margin sacrifices could absorb for many exporters like Zhu. His assessment shifted from manageable difficulty to outright impossibility, describing the situation as lacking even a thread of feasibility and necessitating a halt to U.S.-bound shipments pending potential high-level dialogue. The response from China was equally severe, implementing retaliatory tariffs reaching 125% on American goods. This move effectively closed the Chinese market to many U.S. products, a reality acknowledged officially by China's Central Tariff Office, which declared no possibility for market acceptance under such conditions. The combined effect of these prohibitive reciprocal measures created conditions described by some analysts, such as Josh Lipsky at the Atlantic Council, as tantamount to almost a trade embargo, particularly for lower-value goods where margins are thin. Observable consequences followed swiftly in the logistical sphere. Reports emerged, including one from the financial news service Caixin, indicating a dramatic reduction in U.S.-bound vessel traffic at major ports like Shanghai shortly after the tariffs took effect. Major shipping lines were documented drastically curtailing trans-Pacific routes, reflecting the immediate impact on trade volumes. This disruption fuels concerns among observers like finance professor Chen Jiwu that a prolonged period under such high tariffs could precipitate an effective decoupling of the two economies, unwinding decades of integration. The situation forces businesses on both sides to confront the possibility of needing alternative sourcing or markets, although options may be limited or difficult to access quickly. A notable exception granted by the U.S. administration for electronics, including smartphones and laptops, suggests a recognition of the complexities and time involved in relocating manufacturing for certain sophisticated goods. Further complicating the operational environment for businesses is the uncertainty surrounding the strategic objectives behind the tariff measures. While the previous U.S. administration emphasized a de-risking strategy focused on targeted sectors with national security implications, the current approach involves broad, universal tariffs. Yet, as former trade officials like Greta Page note, the specific goals sought in potential negotiations remain unclear, leaving businesses without a clear roadmap for how or when the situation might be resolved. This ambiguity contributes to the widespread concern noted by consultants like Hu Jianlong, as companies wait anxiously for clarity on the final tariff levels and the path forward. Amidst this environment of high tariffs and diplomatic gridlock, the operational responses from Chinese businesses themselves are far from uniform. Faced with potentially prohibitive costs, some companies, like an athletic wear manufacturer represented by Lisa Lee, are attempting pragmatic solutions. They engage clients in negotiations aimed at sharing the burden of the increased tariffs, while simultaneously initiating explorations into alternative markets such as Australia or Europe, seeking to mitigate dependency on the U.S. However, this strategy of diversification is not universally viewed as viable or straightforward. Other manufacturers, like a holiday lights producer in Wenzhou identified only as Bo, express significant pessimism. Citing perceived weakness in alternative destinations like the European market, this producer sees little recourse but to abandon the U.S. market entirely if the steep tariffs remain in place, highlighting the challenge of finding equivalent replacement markets. Similarly, difficulties arise even for established businesses attempting to pivot. Danny Lau, operating an aluminum coating factory, finds existing U.S. client relationships strained, with future projects uncertain due to the tariff burden. His efforts to penetrate new markets encounter resistance, sometimes because the higher quality of his products translates to price points deemed too expensive in different economic contexts. This pressure has already led some firms to exit the U.S. market completely. A steelmaking business in Tianjin, according to its foreign sales representative David Yu, ceased trading with the United States following earlier tariff increases implemented under both the Trump and previous Biden administrations, opting for what Yu termed the best plan of simply avoiding contact. Yet contrasting sharply with this definitive withdrawal is the stance of exporters like Geoeconomics. Despite facing the same seemingly insurmountable tariff levels that forced him to pause shipments, he continues to hold onto the possibility of resolution. Describing the American market as uniquely reliable and strategically valuable, the best market on earth, his position reflects a decision to wait, enduring the current disruption in hopes of a future return to normalcy, illustrating that not all businesses are ready to sever established ties. This spectrum of responses, from pragmatic adaptation to market abandonment or hopeful waiting, unfolds against a backdrop of stalled high-level communication between Washington and Beijing. The potential for negotiation appears constrained by preconditions set forth by the Chinese government. A foreign ministry spokesperson, Lin Jian, explicitly stated that talks require the United States to halt actions described as maximum pressure and capricious and destructive behavior. This position, according to analysts like Professor Li Cheng, reflects deeper frustrations within the Chinese leadership regarding perceived targeting by the U.S. administration and anxieties about policy consistency. Furthermore, the absence of any scheduled leadership-level discussions in the immediate future compounds the uncertainty facing businesses. Without clear signals from the highest levels of government regarding potential de-escalation or the parameters of any future agreement, companies lack the necessary visibility to make informed strategic decisions beyond immediate tactical adjustments. This prolonged state of ambiguity inevitably forces consideration of more fundamental, longer-term operational shifts. Consultants observing the situation, such as Hu Jianlong, anticipate that a sustained tariff conflict will likely accelerate trends already underway, prompting Chinese businesses to seriously evaluate diversifying supply chains and potentially relocating manufacturing capacity. Destinations could include other countries or, paradoxically, even the United States itself, depending on strategic calculations. Ultimately, the operational reality for Chinese businesses trading with the United States remains deeply challenging. Caught between the immediate economic infeasibility created by the tariffs and the unpredictable timeline for any potential political resolution, they navigate a period of profound uncertainty, where established trade patterns are disrupted and future pathways are obscured. The collective impact of these individual business decisions, driven by the severe tariff environment, extends beyond specific company balance sheets. It points towards a potential reshaping of global manufacturing and logistics networks that were built over decades. The ease with which established trade flows, amounting to hundreds of billions of dollars annually, can be disrupted highlights the inherent vulnerabilities within highly integrated international supply chains when subjected to sudden, drastic policy shifts. This situation didn't arise in a vacuum. Underlying tensions, including persistent trade imbalances and growing Western concerns about competition from Chinese industries in sectors like electric vehicles, formed the backdrop for these escalating trade measures, which began during the first Trump administration and have seen different iterations under subsequent leadership. Whether the ultimate outcome aligns more closely with the targeted de-risking approach favored by the Biden administration or results in the more extensive, effective decoupling feared by some analysts remains indeterminate. What is clear is that the current level of reciprocal tariffs creates significant friction, forcing a reevaluation of long-standing economic interdependencies. The immediate future for businesses engaged in U.S.-China trade, therefore, is characterized by this operational uncertainty, contingent on diplomatic maneuvering and policy choices yet to be made. The path forward hinges on governmental actions that could either alleviate the current pressures or solidify a new, more fragmented global trade reality. Therefore, the operational landscape for Sino-American commerce is currently defined by the prohibitive nature of reciprocal tariffs, exceeding the capacity for routine business adaptation. This has forced Chinese exporters into a period of difficult strategic choices, manifesting in a spectrum of actions from immediate market withdrawal and diversification, efforts to cost-sharing negotiations, and perseverant waiting for de-escalation. Lacking clear diplomatic resolution or predictable policy adjustments from either government, the situation underscores the profound sensitivity of complex global trade networks to abrupt political interventions. It leaves the future structure of this vital economic relationship fundamentally contingent, its trajectory uncertain, and dependent entirely on subsequent governmental decisions and potential shifts in strategic calculus. Thanks so much for watching. If you enjoyed this analysis, and be sure to give it a thumbs up and hit that subscribe button for more geopolitical insights like this. I love hearing your thoughts, so drop a comment below and let's keep the conversation going. Share this video with anyone interested in deeper perspectives on current events. Until next time, stay informed and think critically. Thank you.